We are Insights of the She Shed. I'm Jeanne Gorey, Neighborhood Loans, money in the middle, kind of, sort of side.
Jamie Safransky, Remax Suburban. Julie is not here today. So we are actually going to discuss something that comes up a lot when our buyers are applying for mortgages. We're going to talk about private mortgage insurance, or PMI.
Yes, hey, that's good. And
Yes.
by the way, before we talk about that, we're in Naperville, lovely downtown Naperville.
It's a beautiful day. You can see the covered bridge behind us. We're along
on the Riverwalk.
Yes, we're looking forward. We're probably going to go have some lunch afterwards. It'll be nice.
Beautiful day.
Yes, it is. So, Jeannie,
Yes.
what is private mortgage insurance?
Okay,
PMI.
private mortgage insurance, or PMI, is basically insurance that us lenders get. So in case you default on your mortgage. So it doesn't benefit you necessarily in any kind of way, except it helps us in case you default. However, the benefit to you is, without the private mortgage insurance, you would have to come up with 20% down in order to buy your house. So that does afford you to get a little bit more of a house with less money down.
Yes. Okay, so that means that for a lot of these programs through like FHA, things like that, where it's only like 3% down or 5% down, they would have PMI.
Yes, and it's a little bit different. Oh, and by the way, just a little history of PMI. 1957 was when PMI really kicked in.
Really?
With the mortgage insurance company first started. However, there was some pre-depression era too.
Okay.
But not as common until 1957 when it really went gung-ho. Now, as far as FHA, there's private mortgage insurance, but it's called Mortgage Insurance Premium, or MIP, not PMI.
Just to make things complicated.
Yes, and they do it a little bit differently. They allow you to finance it in on top of your loan amount, as well as you pay a monthly amount on FHA.
Okay.
Now, VA is also a little bit different.
Okay.
It's a very similar thing for the same reasons, I should say, but it's called a funding fee, which helps in case other veterans and you don't pay your mortgage. They have monies to help us defer the costs of your foreclosing.
Got it. Okay, that makes sense. That makes sense. Okay, so how much is it usually, and how do you determine how much you have to pay?
It depends, first of all, on what type of loan you're doing. For conventional, depending on how much you're putting down, if it's 3%, 5%, 10%, 15%, that'll determine, the more you put down, the less it is each month.
Okay.
And it's based on your credit score, it's based on your debt to income ratio, it's based on what type of home you're buying, like condo, townhome, single family, high rise, low rise.
Okay.
Because it depends on the layer of risk that we're going to have. So we have to make sure that we can have these private mortgage insurance companies help us with the risk.
Got it. And then my question, I've had clients ask, well, then how do I get rid of it? It's an extra monthly expense. How do you get rid of it, or,
Well, the one way is to refinance your loan. And if you haven't refinanced yet and your rates are high, this would be a good time to do it and get rid of your PMI.
Definitely.
So this would be a good time.
Yes.
However, if you do have currently a low rate and you feel like either you've prepaid enough, or you have your value of your home has increased, or the combo of the two, you can actually contact your current servicer and tell them you feel you have your 80% loan to value or 78% loan to value, and they'll run an appraisal. You have to pay for the appraisal, however.
You have to pay for the appraisal.
And they will then verify that the 80%, 78% value is there. I should say 80% value is there, and they'll remove it for you.
Right.
However, I keep saying 78% because naturally, if you continue to pay your mortgage, your PMI on a conventional loan will drop off once you reach a 78% loan to value. So it automatically will come up, which is about 10 or 12 years into a 30-year mortgage.
Exactly. And to add to, if you're not 100% sure if you're at about 80%, and you don't really want to pay for an appraisal quite yet, you could contact your real estate agent. Contact me, Julie, and we can at least give you an idea. Our opinion to the mortgage company, they want an actual appraisal, but I've had people contact me and say, hey, what are the homes selling for in my area? What do you think I could get for my house? Because we want to refinance or get rid of our PMI and things like that. So before you pay for an appraisal, you can certainly contact your real estate agent.
And is there a charge for that?
No, we're free.
Free is good.
And it's just an idea. There's no guarantee, obviously. We can't guarantee that the appraiser is going to come back and say that, but it at least gives you an idea. We can give you a ballpark.
And by the way, a lot of the refinancing that we're doing are not even requiring an appraisal.
Okay.
And they automatically are assuming the 20%. So there is that option as well right now to take advantage of if you have not refinanced.
All right. Well, that was some awesome information. Thank you, Jeannie.
Thank you.
We'll see you next week.
See you later.